Okay, in this tutorial, I'll be showing you about URBN stock. I'll just copy this and paste it in Google and write stock besides it. On the left hand side, you can see information from Google, and then on the right hand side, it's from Wikipedia. So the full name of the firm is Urban Fitters Inc. And let's see, if I want to buy the stock right now, what price I have to pay. I have to pay 22.96 US dollars for one stock. And then it was founded in, I can see when it was founded from Wikipedia. I can just click here and I can see the box, and I'll just zoom in for you, and you can see founded in 1970, 49 years ago. And then if I want to know that the sector of this firm, I'll just show you from where I get the sector. First, let me concentrate on the four ratios. That's very important. I've left the link in the description for the ratios website. I use macro trend, which is very nice because you don't have to calculate any ratios. You don't need to know any formulas. Anybody can just look up to it, and you make sure that besides the symbol, there's a name of the firm which matches, because sometimes there's same symbol for more than one firm. So you need to be careful about that. Price book ratio, I'll explain you briefly what that means. Book value is the real value of the stock, and stock price is the market value. For example, if the book value is $1, the stock price could be $2. So it means that you are paying $2 to buy something that is a $1, which means that you're buying something more expensive than you should be buying that off. So the book value, if it's less than one, then you're buying the stock at a discount and at a bargain, which is wonderful. If it's one, that means that the real value and the market value is the same. And if it's more than one, then it means that if the price book ratio is more than one, that means you're buying it more expensive. And if the more higher number it goes, the more expensive it gets. So right now it's 1.61. This means that you are paying 1.61 times more for something you're buying. So it's expensive, but it was 8.03 in 2006 January, which means that if somebody bought the stock at that time, they paid nearly eight times more money. So it was very expensive that time. Compared to that, right now it's 1.61, which is still expensive, okay, but still it is cheaper than in 2006. So, you know, let's go back to other ratios, and let's check the current ratio. Current ratio tells if the assets are more than liabilities. If the ratio is less than 1, that means that it's very risky stock because liabilities are more, which is not good for the firm. If it's 1, that means assets is equal to liabilities. It is good, but if the ratio is 1.5 or more than that, then we have a good margin of safety. Then we're not taking any risk. It's safe to invest in that stock, and it's very less risky. So you need to make sure that when you're investing, you are making sure that you have margin of safety. It's not very risky. It should be 1.5 or more than that. Let's have a look. Right now it's 1.76, which means it's above 1.5, which means it's very safe to invest in. And at the back, like, let's see not only the current ratio, we need to have a look at the previous one as well, the consistency, because it could be that previous one is very low and now it's very high. So you need to be careful. It was 3.11, which is again good because it's more than 1.5, and it's been continuously more than 1.5, continuously. And since the data we have since 2005 up till now, it's always above 1.5. So it means that since like um, nearly 14 years, we have data of 14 years approximately, it's always been very safe to invest in. If I check debt equity ratio means that if the company is mainly operating on long-term debt, then it's very bad for the firm. If it's mainly operating on equity, then it's good for the firm. So we need to make sure that debt to equity ratio is 0.5 or less than that. If it is zero point 0.5 or less than that, that means we have a very good margin of safety. It is very secure. It's not risky. The stock is very good to buy. You know, right now it's 0.75, which is more than zero point 0.5. It means right now the stock is risky to buy. It's not very safe. But let's look at the previous trends. It has been 0 previously, then 0.04, 0.13, 0.10. So it has always been mainly 0, but always been less than 0.5. Only just now they have taken the long-term debt in April, I think, and this year, and it's above zero point 0.5. So which means that it is risky, but if I see the previous trends, it has never taken any debt or it has never been above zero point 0.5. So I might wait for this one and see that they might just pay off very quickly the debt or something like that, because you don't have previous history of getting a lot of debt that crosses the ratio of zero point 0.5. So sometimes there's a one-off thing, so I need to be careful about that. So let's look at return on equity. Return on equity tells us that what we are getting, what the shareholders will be getting. The return, if the return is 8% or more than that, that means that it's very safe, it's very good stock, it's giving a lot of return, and it has good margin of safety, it's doing very well. It's giving a lot of return. Right now it's 19.86%, which is very good, which is way above than 8%. And let's look at the previous ones, consistency. Okay, and it has always been consistent in providing us equity, in providing us a return of more than 8%, which means it's very safe, it's very secure, it's very good, it's doing very good. Let's now search this in Google again, and I want to see if it pays any dividends. It doesn't pay any dividends, and dividend yield is none. So dividend yield, if some firm pays dividend, we need to check this ratio, because if some firm pays dividend, it means that they have extra money generated that they can pay off to their shareholders. So after investing in themselves, the money back, after paying off the loan, after paying to debtors and stuff like that, they still have money left. So that is given to shareholders as dividends. But this firm don't pay off any dividend. But this does not mean, there are many factors to consider. So dividend is one of them. This does not mean that the firm is not doing very good. It could be that they're doing very well, but they're not paying the dividends. So, but if it was paying any dividend, it's a positive sign. So there are many factors to consider. Uh, Now let's look at the market cap. So how big is the firm? The market cap is in billions. I just got this figure from Google. It's very simple. It's a very big firm because it's in billions. And let's look at the reviews, what the employees have to say, because whatever the employees have to say, that gives us the real picture of inside of what it is like working. So I've just seen from Indeed reviews. Indeed is a very good website, and I can see there are 1,500 reviews, okay, which is quite a lot to judge a company, and it's 3.7 reviews, which is quite good for 1,500 reviews. So majority of people, like, it's nearly 4 stars, so it's quite good. So it means the employees are quite happy. So you can read through it as well, the comments. So this is very good then, and I want to look at the Glassdoor as well, because that's very important to check the reviews as well. And according to Glassdoor, it has like, sorry, it has like 2.5 thousand reviews and 3.5 star. So for 2,500, there's a lot of reviews. 3.5 stars is very good, I think. And so we need to look at that as well. And let's look if it has any patents or not. Let's look at that. The website I use is Just Your Patents. You can just get this website link from the description, and I'll just type in the search. And the one I'm more interested in is assignee and applicant, because these are people who have the full rights of the patent. I'm not interested in inventors, because they are the people who invented, but they don't have the full rights. So what I'm looking at right now is applicant and assignee. So we have two patents in 2016 March, filed, and 2000 and December 2016. So we don't have any recent ones. So, I need to look into it. And you need to make sure that they have recent patents as well, because it means they're continuously innovating. So there are only two patents right now, which is also a recent one. In 2016 December they filed. So, like, it's a recent one, I would say. Like, it's nearly 2017. So the patent date of patent is November 2017. So it's a recent one, so I need to look if they have any patents in future as well, because patents act as a moat, and it means that they have competitive edge. So that's really good as well. So Yahoo Finance, I have the link in this description. I'll just search it in the search bar, and I can see here. And if I go to profile, I can see the sector consumer cyclical, and the industry is apparel stores, and full-time employees 9,600. And I just want to show you the key executives, so people who are very important. There are five people and key executives, and you can see that all of their salaries have been shown, which means this firm has shown all of the salaries. It builds trust, because the more information a company reveals, the better it is. So you can see all the salaries as well. And